There's a story, a dangerous and seductive story, that costs aspiring investors more money than any market crash or recession combined. It's a story whispered in online forums, shouted on financial news networks, and packaged beautifully in the investor presentations of charismatic founders. It's the story of the future, the story of disruption, the story of a product or a technology so revolutionary that it will change the world. And because it will change the world, the old rules of finance don't apply. Profits don't matter today. Cash flow is a quaint, outdated concept. All that matters is believing in the story, buying the dream. And for a time it seems to work. The stock price levitates, detached from any earthly metric of performance, fueled by pure, uncut narrative. Those who bought in feel like geniuses. Those who stayed out feel like fools. But then, inevitably, gravity reasserts itself. The story collides with reality. The dream dissolves into the harsh light of a quarterly earnings report, and the capital of those who believed is vaporized. This cycle of narrative-driven speculation is the single greatest enemy of the retail investor. It is a siren song that has lured countless portfolios onto the rocks, from the dot-com bubble of the late 90s to the speculative manias of our current age. It preys on our most human instincts, our love of a good story, our fear of missing out, our desire to believe we found a secret key to effortless wealth. But there is an antidote. There is a framework so powerful, so ruthlessly logical, that it acts as a permanent shield against the seductive whispers of story stocks. It is the mental model at the very core of the greatest wealth creation engine in history, the mind of Warren Buffett. And it's not some complex algorithm or a secret formula locked away in a vault in Omaha. It is a single profound principle. A simple piece of math that, once you truly understand it, will change the way you look at the market, at business, and at your own financial future forever. The principle is this: the value of any business is the total sum of cash it will generate for its owners from this moment until the day it closes its doors, with one crucial adjustment, that future cash must be discounted to what it's worth in today's money. That's it. That is the final promise. Not a promise of a hot stock tip or a get-rich-quick scheme, but the promise of a mental tool that will allow you to navigate the treacherous waters of the market with clarity, discipline, and confidence. It prevents the costliest mistake an investor can make, paying a crazy price for a compelling story with no profits, based on a vague hope for the future, without doing the simple, essential math on what that business could actually be worth. By internalizing this framework, you will undergo a financial transformation. You will stop speculating on flickering stock tickers and start investing in businesses. You will ground your decisions in realistic projections of cash, not in the intoxicating ether of hype. You will learn to see what others miss, to act with courage when others are panicking, and to exercise patience when others are caught in a frenzy of greed. This is not just another stock analysis technique. It is a fundamental shift in perspective, a disciplined, business-like framework for valuation that separates the amateur from the professional, the gambler from the capital allocator. It is the key to building a portfolio of wonderful, profitable companies bought at reasonable prices, the one sure path to durable, long-term portfolio growth and true financial freedom. The journey begins not with a spreadsheet but with a foundational shift in identity. It begins by embracing the Oracle of Omaha's first and most important edict. A business is not a ticker symbol. To the world, a stock is a four-letter code that flashes green or red on a screen. It's an abstract concept, a token in a global casino, something to be traded, flipped, and bet upon. To Warren Buffett, that same stock is something entirely different. It is a fractional ownership certificate in a living, breathing enterprise. It is a claim on a small piece of a company's factories, its brands, its customer relationships, and most importantly, its future earnings power. This distinction is not semantic. It is the philosophical bedrock upon which all intelligent investing is built. Ignoring it is the first step on the road to ruin. Understanding it is the first step toward building generational wealth. To truly grasp the power of this mindset, we must travel back to 1972, to a decision that would not only make Buffett and his partner Charlie Munger extraordinarily rich, but would forever alter the course of their investment philosophy. It was a deal centered not on technology or complex financial engineering, but on something far more timeless: boxes of chocolate. The company was See's Candies, a beloved West Coast institution famous for its high-quality chocolates and its fiercely loyal customer base. See's was put up for sale, and a friend of Buffett's recommended he take a look. At the time, Buffett was still very much a practitioner of the old-school cigar butt style of investing he had learned from his mentor, Benjamin Graham. This approach involved finding statistically cheap companies, often mediocre businesses trading for less than the value of their assets. You'd buy a stock for 50 cents that had $1 of working capital, wait for the market to recognize the discrepancy, and sell for a quick profit. It was like finding a discarded cigar on the street with one good puff left in it. Profitable, but not scalable, and certainly not a way to own the truly great businesses of the world. See's Candies was different. It wasn't a struggling cigar butt. It was a gem. The business earned about $2 million after tax, and it required almost no capital to run. Customers paid in cash for the product up front, and the company paid its suppliers later. This created what is known as float, a source of cost-free financing. More importantly, the See's brand was so powerful in the minds of its customers that it had pricing power. Every year, it could raise the price of its chocolates a little bit, and people would happily pay, especially during holidays and special occasions. It was, in short, a wonderful business. The See family was asking for $30 million. Buffett and Munger, after studying the financials, calculated that the business was worth taking a serious look at, but they felt the price was too high. They did their own stock analysis, not on a public company, but on a private one, and concluded that they wouldn't pay a penny over $25 million. For them, this wasn't just a number on a page, this was the value of the business. Their calculation of its future cash flows, its owner earnings, discounted back to the present, led them to that figure. The sellers refused. Negotiations stalled. For Buffett, still deeply rooted in the price-sensitive teachings of Graham, the $5 million gap seemed like a chasm. He was ready to walk away. This is a critical moment. The average investor, enchanted by the story of a beloved brand, might have stretched, thinking, "What's another $5 million?" But Buffett was a business analyst, not a storyteller. The numbers had to work. It was Charlie Munger who pushed him. Munger saw that this was not a cigar butt. This was a franchise, a business you could own forever, one whose earnings would grow year after year without needing massive capital injections. He convinced Buffett that paying a premium for a superior business was a far better strategy than getting a bargain on a mediocre one. Reluctantly, Buffett agreed, and they purchased See's for $25 million. In the years that followed, See's Candies became a gusher of cash. It has since generated well over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital. The initial $25 million investment was returned many times over. The experience fundamentally rewired Buffett's brain. It taught him the profound difference between price and value. The market for See's Candies, the negotiation with the sellers, was setting a price, but the value, the intrinsic value, was determined by the future cash the business would produce. He realized that buying a piece of a wonderful business, even at a fair price, was infinitely better than buying a fair business at a wonderful price. He stopped seeing himself as a stock picker, a trader of market securities. He saw himself as a business owner, an acquirer of companies. When he bought shares in Coca-Cola, he wasn't buying the ticker symbol KO. He was buying a piece of the global institution that puts its sugary beverages within arm's reach of nearly every human on the planet. When he bought shares in Apple, he wasn't betting on the next iPhone cycle. he was buying a share of the most powerful consumer ecosystem ever created. This mental shift is everything. It is the core of the Warren Buffett strategy. The psychological principle that this mindset overrides is one of the most pervasive and destructive in finance, the affect heuristic, amplified by confirmation bias. The affect heuristic is a mental shortcut our brains use to make complex decisions. Instead of answering the hard question, what is the discounted value of the future cash flows of this enterprise, we subconsciously substitute an easier one. How do I feel about this company? Do we like its products? Is its CEO on the cover of magazines? Does the stock chart look like it's going up and to the right? These feelings, these affects, create a positive glow around the stock, which we then use to justify our investment decision. We fall in love with the story, the narrative, the ticker. Confirmation bias then locks us into this emotional decision. Once we've decided we like a stock, our brain actively seeks out information that confirms our belief and filters out anything that contradicts it. If we buy a tech stock because we believe in its visionary founder, we will eagerly consume articles praising their genius and dismiss reports about mounting losses or intensifying competition as mere noise. We look at the rising stock price not as a potential sign of a bubble, but as proof of our own intelligence. We become emotionally attached to the ticker symbol, defending it as if it were a favorite sports team. This combination is lethal. It transforms us from objective business analysts into biased fans, making rational stock valuation impossible. Buffett's approach systematically dismantles this trap by forcing the focus away from feeling and onto fact, away from the ticker and onto the business. So how can a retail investor, without the vast resources of Berkshire Hathaway, apply this foundational mental model? The blueprint is a simple but powerful exercise in perspective shifting. I call it the Sole Inheritor framework. First, choose a publicly traded company that you find interesting. It could be a company whose products you use, or one in an industry you understand. For the next 7 days, you are forbidden from looking at its stock price. Your screen is locked. Instead, you will operate under a single premise. You have just inherited 100% of this business. You are the sole owner. You cannot sell it for at least 10 years. Your entire family's financial future now depends on the success or failure of this single enterprise. What do? Your first and only task is to understand what you now own. You will find the company's most recent annual report, the 10K filing. This document, which most investors ignore, is now your owner's manual. You will read it cover to cover, not as a collection of numbers, but as a letter from the management team to you, the new owner. As you read, you must answer 3 critical questions. 1. How precisely does this business make money? What does it sell? To whom? And why do they choose this company over its competitors? 2. What are the most significant threats to its long-term profitability? Who is trying to eat your lunch every single day? Is it a new technology, a powerful competitor, a shift in consumer behavior, or a regulatory threat? Be brutally honest. 3. If you had to invest an additional $1 million of your own family's money to strengthen the business for the next decade, where would you deploy that capital? Would you build a new factory, increase the marketing budget, acquire a smaller competitor, or is there no intelligent place to put more money a sign in itself? By forcing yourself through this week-long exercise, you will achieve a profound transformation. The company will cease to be an abstract ticker symbol and will become a tangible business in your mind. You will start to think about its competitive advantages, its management quality, its capital allocation decisions. You will develop a visceral understanding of its economics. This is the first and most crucial step in any legitimate stock analysis. It provides the qualitative foundation upon which any quantitative valuation must be built. You have shifted your identity from a speculator in the stock market to a partner in a business enterprise. This change in perspective is the true beginning of your journey towards financial freedom. To fully appreciate the power of this approach, we must examine its antithesis, the path of the 99%, the world of the day trader. The day trader's reality is the polar opposite of the business owner's. Their world is not the 10K report. It is the flickering candlestick chart. Their language is not of profit margins and return on capital, but of moving averages, support and resistance levels, and stochastic oscillators. They don't analyze businesses. They analyze patterns on a screen, believing that the past wiggles of a stock price hold a secret key to its future movements. They are not concerned with the company's long-term prospects. They are obsessed with its next 10-minute or even 10-second move. The ultimate manifestation of this delusion was the GameStop saga. Here was a brick-and-mortar video game retailer with a fundamentally broken business model in a world rapidly moving to digital downloads. The business itself was in terminal decline. By any rational measure of intrinsic value, the company was worth very little. But a narrative took hold, a compelling story of a populist uprising against hedge funds. The ticker, GME, became a symbol, a meme. It became completely divorced from the underlying business. People were buying the ticker, not the company. They were caught in a frenzy of affect and confirmation bias, cheering each other on as the price soared to astronomical levels. They felt like geniuses. But the story was not a business plan. The meme was not a source of cash flow. When the narrative faded and the emotional intensity waned, the stock price collapsed, wiping out the capital of countless individuals who arrived late to the party. They weren't investing in a business. They were participating in a mass psychological event, a modern-day tulip mania. This is the ultimate danger of treating stocks as tickers. It severs the connection to business reality and makes you a pawn in a game of market sentiment, a game you are almost certain to lose over time. The direct financial connection of adopting the business owner mindset is profound and manifests in several critical ways that dramatically enhance long-term portfolio growth. Firstly, it drastically reduces portfolio turnover. When you think like an owner, you are looking to hold your stake in a great business for years, even decades. You are not tempted to sell because of a scary headline or a disappointing quarterly report. This long-term perspective has a massive financial benefit: the deferral of capital gains taxes. The constant buying and selling of the trader triggers a tax event with every profitable trade, a significant portion of which is sent to the government each year. This is a huge self-inflicted drag on compounding. The long-term owner allows their capital to grow and compound tax-deferred for decades, a massive advantage that is central to any intelligent wealth management strategy. Secondly, this mindset forces you to focus on the only thing that drives long-term stock prices: the growth in a business's underlying earnings power. Market sentiment can make a stock price do anything in the short run. But over a 5, 10, or 20-year period, the price will inevitably follow the trajectory of the company's profits. By focusing on the business, you align your portfolio with the most powerful force in finance, the compounding of corporate earnings. You are no longer betting on market psychology. You are investing in the engine of capitalism itself. This shift from short-term price action to long-term business performance is the foundational secret to beating the market. Not for a week or a month, but for a lifetime. It is the first and most important piece of the puzzle. Once you have accepted that you are buying a business, not a ticker, the next logical question is, what is this business generating for me, the owner? This brings us to the second, and perhaps most misunderstood, pillar of Buffett's valuation framework: the cash flow crystal ball. At the heart of the thesis that a business is worth the cash it will generate lies a critical definition: what exactly is cash? It seems like a simple question, but in the world of corporate accounting, it is anything but. The average investor, and even many so-called professionals, looks at the headline number, net income, or earnings per share, EPS. This is the number blasted across financial news channels, the figure that determines whether a company beat or missed expectations. But Buffett knows that net income is often a poor reflection of a company's true economic reality. It is an accountant's opinion, subject to a wide range of assumptions and manipulations. The real prize, the number that cannot be easily faked, is cash. Specifically, a metric Buffett long ago termed owner earnings. This is the true, unfiltered cash flow that a business generates, the money an owner could theoretically pull out of the business at the end of the year without harming its long-term competitive position. Mastering this concept is the key to creating an accurate stock valuation and avoiding the traps hidden in standard financial statements. To see this principle in action on a colossal scale, we look to the depths of the great financial crisis in 2009. The global economy was in freefall. Fear was rampant. The stock market was collapsing. It was in this environment of pure panic that Warren Buffett made one of the largest bets of his career: the acquisition of the Burlington Northern Santa Fe (BNSF) Railroad for a staggering $44 billion. To the outside world, it seemed like a bizarre move. Railroads were the epitome of the old economy. They were dirty, capital-intensive, unionized, and decidedly unsexy. The story stocks of the day were in technology and finance, not in hauling coal and grain across the American heartland. But Buffett wasn't buying a story. He was buying a business with a unique and powerful economic engine. He saw what others, blinded by fear and a focus on superficial metrics, missed. BNSF was a cash-generating machine. Buffett didn't fixate on the reported net income of the railroad. He dug deep into its financial statements to calculate its true owner earnings. He started with the net income, but then he made crucial adjustments. He added back the massive non-cash charge for depreciation. Railroads have to spend billions of dollars every year just to maintain their vast network of tracks, locomotives, and rail cars. This spending is called capital expenditure, or CapEx. The accounting rules allow a company to spread the cost of these assets over many years through depreciation. Buffett knew this was an accounting fiction. The real cash cost was the CapEx spent each and every year to keep the business running. He meticulously analyzed BNSF's history of capital expenditures, separating the, quote, maintenance CapEx needed to stay in the same place from the growth CapEx used to expand the business. He subtracted this realistic maintenance CapEx from the cash flow figure. What remained was a colossal number, a river of cash that the business generated year after year, in good times and bad. He saw a business that was part of a duopoly in the western United States, a massive competitive advantage, or moat. He saw a business whose service was essential to the functioning of the American economy. While other investors were dumping stocks in a panic, Buffett was coolly calculating the present value of BNSF's future owner earnings. And that calculation told him that buying the entire railroad for $44 billion was an absolute bargain. It was an all-in wager on the economic future of the United States, as he put it. A wager not on a story, but on the predictable, long-term cash-generating power of an essential, well-protected business. That investment has been spectacularly successful, generating billions upon billions in cash for Berkshire Hathaway shareholders, proving that the most profitable insights often come from looking at what everyone else is ignoring. The psychological reason we so often fail to make this distinction between accounting earnings and real cash is rooted in the narrative fallacy and salience bias. Our brains crave simple stories. The company reported record earnings is a simple, clean narrative. It's salient, meaning it's prominent and easily available. It's the headline on the news report. The deeper truth: the company's net income was up, but after accounting for the massive capital expenditures required to generate that income, their free cash flow was actually negative, is a complicated, messy story. It doesn't fit into a tidy narrative. So our brains, seeking cognitive ease, latch onto the simple, salient number, net income, and discard the more complex, more important one, owner earnings. We build a story of success around the reported earnings, and this story feels good. We are biased towards information that is easy to access and process. Financial journalists, catering to this bias, report on EPS beats and misses, reinforcing the idea that this is the metric that matters. Corporate executives, knowing this, sometimes manage their accounting choices to produce the smoothest possible trend in reported earnings, even if the underlying cash reality is far more volatile. This creates a dangerous feedback loop where investors are conditioned to focus on a metric that can be easily manipulated and often fails to represent the true economic health of a business. Buffett's focus on owner earnings is a disciplined, rational rebellion against this psychological trap. It forces a confrontation with the messy reality of a business's cash generation, bypassing the comforting but often misleading narrative of reported profits. So how can you, the retail investor, perform this crucial calculation? You don't need a PhD in finance. You just need to know where to look in a company's financial statements. Here's the blueprint for calculating a conservative estimate of owner earnings. Step 1. Find the company's cash flow statement in its latest annual or quarterly report. This is one of the three main financial statements, along with the income statement and the balance sheet. Step 2. Start with the reported net income. This is usually the first line in the cash flow from operations section. Step 3. Add back all non-cash charges. The most significant of these are typically depreciation and amortization. The company didn't actually spend this cash during the year. It's an accounting expense reflecting the gradual wearing out of past investments. So you add it back to get a clearer picture of the cash the operations are generating. Step 4. This is the most important and most nuanced step. You must subtract the average annual maintenance capital expenditures. This is the amount of money the business has to spend each year just to keep its current operations humming, to replace old machines, update software, or repair buildings. You'll find capital expenditures, CapEx, in the cash flow from investing section. The trick is that CapEx can be lumpy. A company might build a huge new factory one year and spend very little the next. To get a realistic number, you should look at the last 5 to 7 years of CapEx and calculate an average. For a business that isn't growing, this average is a good proxy for maintenance CapEx. For a growing business, you may need to conservatively estimate what portion of that average CapEx is for maintenance versus growth. This requires judgment, which is why investing is an art as well as a science. Step 5. Account for any major changes in working capital. If a company has to constantly tie up more and more cash in inventory or accounts receivable just to stand still, that cash isn't available to you as an owner. The resulting number from this 5-step process is your estimate of owner earnings. It is the golden key, the primary input for any intelligent stock valuation. It represents the real cash profit of the enterprise. The antithesis of this disciplined, cash-focused approach is the widespread and dangerous reliance on a metric called EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. In the 1980s, during the leveraged buyout boom, private equity firms and Wall Street bankers began popularizing EBITDA as a proxy for cash flow because it made it easier to justify loading companies up with debt. It's a seductive number because it's always much larger and prettier than net income or real free cash flow. It essentially shows you what the earnings would be if the company had no debt, paid no taxes, and its assets never wore out. Charlie Munger has famously said, "I think that every time you see the word EBITDA, you should substitute the words bullshit earnings." Warren Buffett is equally scathing, pointing out the absurdity of ignoring the very real cash cost of maintaining capital assets. He once quipped, "Does management think the tooth fairy pays for capital expenditures?" Using EBITDA to value a business is like assessing the cost of owning a car by looking only at the monthly payment and ignoring the cost of gas, insurance, and repairs. For capital-intensive businesses like railroads, airlines, or manufacturing companies, the difference between EBITDA and true owner earnings is a chasm. Relying on EBITDA can make a terribly unprofitable hamster wheel business, one that has to reinvest every penny it makes just to stay afloat, look like a cash-generating superstar. This is a classic value trap, a way to pay a high price for a low-quality business, a mistake that a focus on owner earnings will help you avoid every single time. Avoiding bubbles and disastrous investments often comes down to simply ignoring these flawed, narrative-friendly metrics and doing the harder work of calculating the real cash. The direct financial connection between understanding owner earnings and your portfolio growth is monumental. This single metric is the lifeblood of shareholder value. A business with strong and growing owner earnings has options, and all of these options directly benefit you, the shareholder. First, it can reinvest that cash into high-return growth projects, opening new stores, developing new products, or expanding into new markets. If management is skillful, this is the most powerful way to compound your wealth. Second, it can use the cash to pay down debt, strengthening the balance sheet and reducing risk. Third, it can buy back its own shares. If the shares are trading below their intrinsic value, this is a wonderfully tax-efficient way to increase your ownership stake in the business without you having to lift a finger. Fourth, it can pay a dividend, sending a portion of the cash directly into your brokerage account. A company with high reported net income but low or negative owner earnings has none of these options. It is an economic illusion. Its stock price may be propped up by a good story for a while, but eventually its inability to generate real cash will be exposed, and the stock will stagnate or fall. By building a portfolio of companies that are proven generators of owner earnings, you are aligning yourself with businesses that have the financial firepower to create tangible, sustainable shareholder value year after year. This is the engine of compounding, the surest path to long-term stock-picking success, and the bedrock of any serious wealth management plan. We've established that we're buying a business, not a ticker. We've defined the critical metric for that business, its owner earnings. Now we arrive at the mathematical core of the entire framework, the third pillar, the time value of money, or the discounting mechanism. This is the part of the principle that says the value of a business is its future cash flows, adjusted for today's money. This concept, while sounding academic, is one of the most powerful ideas in all of finance, and it is the engine that translates your forecast of future owner earnings into a concrete, actionable valuation for a stock today. The simple truth is that $1 you are certain to receive a year from now is worth less than $1 in your pocket today. Why? Because you could take that dollar today, put it in a risk-free investment like a U.S. Treasury bill, and have more than $1 a year from now. That interest rate, that rate of return you could get with zero risk, acts like a force of gravity on the value of all other assets. The higher the risk-free interest rate, the stronger the pull of gravity and the less a future stream of cash is worth today. Understanding how to use this financial gravity to your advantage is what separates a novice from a master in the art of stock valuation. It is the central logic behind the discounted cash flow, or DCF, model. A beautiful illustration of this principle in practice was Warren Buffett's investment in the Washington Post Company in the early 1970s. This was a period of intense market pessimism. The Nifty 50 growth stocks had crashed, and the general sentiment was bleak. The Washington Post, despite owning the dominant newspaper in the nation's capital, several TV stations, and Newsweek magazine, was deeply unloved by Wall Street. Its stock price had been hammered, and the market valued the entire company at a mere $80 million. Buffett, however, saw a completely different reality. He wasn't focused on the market's gloomy mood. He was focused on the business, and the business was a fortress. The Washington Post newspaper was a local monopoly. If you were a department store in D.C. and you wanted to advertise, you had no other choice. This gave the company incredible pricing power. It was a gusher of cash. Buffett did what the market was unwilling to do. He looked past the next year and tried to project the company's owner earnings out over the next 5, 10, and 20 years. He knew this cash stream was not only durable but likely to grow substantially. Then he performed the crucial second step. He discounted that future river of cash back to its present value. What discount rate did he use? We can't know for sure, but we know how he thinks. The discount rate is, in essence, your opportunity cost. The baseline is the return you can get from the safest investment available. At the time, a long-term U.S. government bond yielded around 7 or 8%. So any investment in a stock had to promise a significantly higher return to compensate for its additional risk. Let's say he used a discount rate of 10 or 12%. When he ran the numbers, discounting the decades of future cash flows from the Post's powerful media franchises back to the present day, the result was staggering. His stock analysis revealed that the intrinsic value of the Washington Post company was not $80 million, but somewhere north of $400 million, perhaps even $500 million. The market was offering him the chance to buy a dollar bill for less than 20 cents. He acted decisively, investing over $10 million, a huge sum for him at the time, to acquire a large stake in the company. That investment became one of the cornerstones of Berkshire Hathaway's success, eventually growing to be worth over $1 billion. He was able to make this bold, contrarian move because he had a rational framework for valuation. The DCF model gave him the courage of his convictions, allowing him to see immense value where the rest of the market saw only fear and uncertainty. The psychological bias that the discounting mechanism so powerfully corrects is known as hyperbolic discounting. This is our brain's innate tendency to dramatically prefer immediate rewards over larger, delayed rewards. It's the reason a person might choose to receive $50 today instead of $100 a year from now, even though the latter is a 100% annual return. It's the force that drives procrastination and our failure to save adequately for retirement. The future feels abstract and distant, while the present is tangible and urgent. In investing, this bias manifests as an irrational obsession with short-term performance. We are mesmerized by the speculative stock that might pop 50% next week, and we are bored by the stable, profitable company that is likely to compound its value at 15% per year for the next 20 years. The quick hit feels more valuable, even though the math clearly shows the long-term compounder is the path to true wealth. The discounted cash flow model is a purely rational antidote to this deeply irrational human tendency. It forces you to mathematically connect the long-term future to the present. It makes you confront the fact that the vast majority of a company's value lies not in next quarter's earnings, but in the cumulative stream of cash it will produce over its entire lifetime. By systematically translating that distant future into a concrete present value, the DCF framework rewires your brain to think and act like a long-term business owner, not a short-term gambler. Now let's build the blueprint for a simple, practical, discounted cash flow model that any retail investor can use. It sounds intimidating, but the logic is straightforward. Step 1. Project the company's owner earnings, which you learned how to calculate in the previous pillar, out for the next 10 years. You will start with the current year's owner earnings, and then apply a reasonable growth rate. The key here is to be conservative. It's far better to be surprised on the upside. For a stable, mature company, you might project growth of 3 to 5% per year. For a faster-growing company, you might use a higher rate for the first few years, and then taper it down. This is the art of valuation, grounding your assumptions in the reality of the business and its industry. Step 2. Estimate a terminal value. A business doesn't just cease to exist after 10 years. The terminal value is a lump sum estimate of the value of all its cash flows, from year 11 into perpetuity. A simple and conservative way to calculate this is to take the owner earnings from year 10, grow it by a very small perpetual rate, like the long-term rate of inflation, say 2 or 3%, and then divide that number by your discount rate minus that perpetual growth rate. Step 3. Choose your discount rate. This is one of the most important inputs. Your discount rate is your required rate of return. It's the minimum annual return you demand to compensate you for the risk of owning this particular stock. A good starting point is to take the current yield on the 10-year U.S. Treasury bond and add an equity risk premium of 4 to 6%. So if the 10-year Treasury is at 4%, your discount rate might be between 8 and 10%. For a riskier, more speculative business, you should demand a higher return and thus use a higher discount rate. Step 4. Do the discounting. For each of the 10 years of projected cash flows, and for the terminal value, you will discount it back to its present value. The formula is present value equals future cash flow / 1 plus discount rate * number of years. So the cash flow from year 1 is divided by 1 plus discount rate to the power of 1. The cash flow from year 2 is divided by 1 plus discount rate to the power of 2, and so on. The terminal value is discounted back from year 10. Step 5. Sum it all up. Add the present values of the 10 years of cash flows and the present value of the terminal value. This final number is your estimate of the total intrinsic value of the entire business. To get a per-share value, you simply divide this total value by the number of shares outstanding. You now have a tangible, defensible estimate of what the business is truly worth, a number derived from a rational analysis of its future cash-generating capacity. This number is your North Star, your anchor of value in the stormy seas of market sentiment. This is the core of how to value a stock in a disciplined way. The antithesis to this rigorous cash flow-based valuation is the far more common and intellectually lazy method of relative valuation. This is the approach used by the 99% of market participants. Instead of asking the fundamental question, what is this business worth? They ask a much simpler, more dangerous question, what are other people paying for similar businesses? They look at metrics like the price-to-earnings (PE) ratio, the price-to-sales (PS) ratio, or enterprise value to EBITDA. They compare a company's PE ratio to its competitors or to its own historical average. If a company is trading at a PE of 15 and its competitors are at 20, they conclude the stock is cheap. This method requires no forecasting, no deep thought about the business, and no understanding of cash flow. It is a valuation method based entirely on social proof. Its underlying logic is not one of intrinsic value, but of the greater fool theory, the belief that you can profitably buy an overvalued asset because there will always be a greater fool willing to pay an even higher price. This works wonderfully in a bull market, where sentiment is rising and multiples are expanding across the board. But it is a recipe for disaster when the tide goes out. The dot-com bubble was the ultimate showcase for the failure of relative valuation. Companies with no earnings, and therefore an infinite PE ratio, were valued based on price per eyeball or other nonsensical metrics. Analysts justified sky-high valuations by saying, well, it's cheaper than this other profitless company. When the narrative broke and investors suddenly started demanding profits and cash flow, the entire house of cards collapsed, as there was no foundation of intrinsic value to support the prices. Relative valuation is a game of musical chairs. A DCF analysis is a blueprint for building a house. The direct financial connection of mastering the DCF framework is that it provides your entire investment process with an anchor of rationality. It allows you to operate as a true contrarian not for the sake of being different but because you have done the work and have a justifiable basis for your view of value. When a market panic hits and a wonderful company's stock drops by 30% due to fear, the relative value investor sees only a broken stock chart and sells with the herd. The intrinsic value investor, armed with their DCF analysis, consults their spreadsheet and sees that the price has now fallen far below their calculated value. They are able to act with courage, buying when others are fearful, knowing they are getting a bargain. Conversely, in a roaring bull market, when a stock they own has doubled or tripled and the media is celebrating its success, the intrinsic value investor can coolly assess that the price now far exceeds its intrinsic value. They can trim their position or sell completely, banking their capital gains, while the relative value investors are piling in, chasing momentum. This disciplined ability to buy low and sell high, based on a calculated, independent assessment of value, is the single most powerful engine for beating the market over the long term. It transforms investing from a game of emotion and guesswork into a disciplined process of identifying discrepancies between price and value, a core skill for any entrepreneur or serious capital allocator. We have now assembled the core machinery of valuation. We know to think like a business owner, we know to focus on owner earnings, and we know how to discount those earnings to a present value. But before we can deploy this machinery, we must confront the single most powerful force working against it, the human brain's insatiable appetite for a good story. This brings us to our fourth pillar, the story stock siren song, and why compelling narratives destroy capital. A story stock is a company whose market valuation is based not on its current financial performance, but on a narrative about its potential future dominance. The story is often intoxicating: a visionary founder, a disruptive technology, a massive addressable market, a promise to change the world. The narrative is so powerful that it creates a reality distortion field around the stock, causing investors to abandon the rigorous valuation principles we've just discussed and instead buy the dream. This is the most dangerous trap in the market, because it pits cold, hard math against millions of years of human evolution that have wired our brains to respond to and be persuaded by stories. Overcoming this is a supreme test of an investor's discipline. There is no greater example of this discipline than Warren Buffett's behavior during the white-hot dot-com bubble of the late 1990s. The narrative was, at the time, utterly irresistible. The internet was going to change everything. A new economy was being born where the old rules of profitability and cash flow no longer applied. It was a paradigm shift, and anyone who didn't get on board was a dinosaur, a relic. Companies with names like Pets.com, Webvan, and TheGlobe.com, which had little more than a business plan and a catchy domain name, were rocketing to billion-dollar valuations overnight. Meanwhile, Warren Buffett and Berkshire Hathaway were sitting on the sidelines, continuing to invest in insurance companies, candy makers, and furniture stores. The financial media began to openly mock him. A famous cover of Barron's magazine in 1999 was titled, "What's Wrong, Warren?" The article detailed his underperformance and suggested that the legendary investor had lost his touch, that his value investing philosophy was dead, a relic of a bygone industrial era. The pressure to capitulate, to join the party, must have been immense. His investors were watching their neighbors get rich on tech stocks, while Berkshire's stock was lagging. But Buffett remained unmoved. His refusal to invest was not based on a Luddite's fear of technology, it was based on his unwavering commitment to his valuation principles. He explained, simply, that he could not with any degree of certainty project the owner earnings of these new internet companies 5, 10, or 20 years into the future. He famously said, "The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors." The story of the internet was fascinating, and he didn't doubt it would change the world. But a great story about an industry is not the same as a great business with a predictable stream of cash flows. He couldn't answer the question, how much cash will this business generate, and how certain am I of that projection? Because he couldn't answer that question, he couldn't perform a rational valuation. And if he couldn't perform a rational valuation, he would not invest. He chose to accept the temporary pain of looking like a fool in order to avoid the permanent pain of losing his investors' capital. When the bubble inevitably burst in 2000 and 2001, wiping out trillions of dollars of market value and shuttering hundreds of these story stocks, Buffett's discipline was vindicated. He hadn't lost his touch. He had simply refused to abandon the timeless principles of business valuation in the face of a collective mania. The psychological forces at play here are the narrative fallacy, which we've touched on, combined with a powerful dose of overconfidence bias. The narrative fallacy, a term coined by Nassim Nicholas Taleb, describes our tendency to create and believe coherent stories to explain random facts. A stock price going up is a random fact. The story we tell ourselves, it's going up because this visionary CEO is a genius and this technology is the future, makes that fact feel understandable and predictable. This story is far more compelling and cognitively easy than a spreadsheet of discounted cash flows. This effect is then supercharged by overconfidence bias. After we have a few successful investments, especially in a bull market where everything is going up, our brain starts to release dopamine. We begin to attribute our success not to luck or a rising market tide, but to our own superior skill and insight. We believe we have the unique ability to pick the next big thing. This overconfidence makes us dismiss risks and ignore contradictory evidence. We stop questioning the narrative and start believing we are part of it. The combination is a potent cocktail of cognitive error. The compelling story makes us want to believe, and our overconfidence convinces us that we are right to believe. This is the psychological state that allows an otherwise rational person to invest their life savings in a company with no revenue, no profits, and no viable business model, simply because it has a good story. To defend against this powerful psychological assault, we need an equally powerful mental model. The most effective is one championed by Charlie Munger: invert, always invert. Instead of asking how an investment can succeed, you must rigorously and systematically ask, how can this investment fail? This simple inversion of the question forces you to shift your focus from the seductive upside of the story to the cold, hard realities of the risks. Here is the blueprint for applying this model. Step 1. Take the exciting story of the company you're analyzing and, for a moment, accept it as a potential future. Then, your job is to become the ultimate pessimist, the pre-mortem analyst. Your goal is to write the obituary for this investment, 5 years in the future. Step 2. Brainstorm and list every single thing that could have gone wrong to lead to its failure. Don't be gentle, be brutal. Could a better funded competitor emerge and crush them? Could the technology prove to be a dead end or be leapfrogged by something better? Could the charismatic CEO who is central to the story get hit by a bus or leave for a rival? Could a change in government regulations make their entire business model illegal or unprofitable? Could a shift in consumer preferences make their product obsolete? Could they simply run out of cash before ever reaching profitability? Write down at least 10 distinct, plausible failure scenarios. Step 3. For each of these scenarios, try to assign a rough probability. How likely is this risk to materialize? This process forces you to confront the base rates of business. What percentage of new technologies actually achieve mass adoption? What percentage of startups survive beyond 5 years? Step 4. Reevaluate your cash flow projections in light of this risk analysis. The story always assumes a perfect, linear path to success. Your inverted analysis reveals the messy, branching paths of potential failure. If the core of the investment case rests on a single technology working perfectly, or a single person staying at the helm, you have identified a fragile investment, not a robust one. This inversion process is a powerful antidote to the narrative fallacy. It grounds you in the base rates of reality and highlights the risks that the optimistic story is designed to make you ignore. It is an essential tool not just for a retail investor, but for entrepreneurs evaluating the viability of their own ventures. The antithesis of this disciplined, risk-focused approach can be seen in the modern phenomenon of thematic investing, often exemplified by funds that focus on disruptive innovation. The core strategy is to identify powerful, world-changing trends like artificial intelligence, genomics, or blockchain, and invest in a basket of companies poised to benefit from those trends. This is the story stock strategy, institutionalized and packaged into an ETF. The appeal is immense. It taps directly into our desire to be part of the future. The narratives are brilliant, often accompanied by slick presentations and charismatic portfolio managers who become media stars. In a bull market fueled by low interest rates and a speculative fervor, this strategy can produce breathtaking returns, as valuations for any company associated with the right story detach from fundamentals and soar into the stratosphere. However, this approach is the polar opposite of the Warren Buffett strategy. The starting point is the top-down narrative, not the bottom-up analysis of an individual business's cash flows and competitive advantages. Valuation often takes a back seat to the perceived size of the potential market. The focus is on revenue growth at all costs, with profitability being a distant, often theoretical future concern. The danger is that this entire strategy is critically dependent on a specific market environment, one of cheap money and a high appetite for risk. When that environment changes, when interest rates rise and investors begin to demand not just stories but profits, these portfolios can experience catastrophic drawdowns. The very same concentration in speculative high-beta stocks that produces spectacular gains on the way up produces equally spectacular losses on the way down, a brutal lesson in avoiding bubbles that many investors have had to relearn recently. The direct financial connection between avoiding story stocks and your portfolio's health is profound, and it centers on the concepts of volatility and drawdowns. A portfolio constructed around story stocks is inherently fragile. Its value is not anchored to the solid ground of current profitability, but floats on the shifting winds of market sentiment and narrative belief. When the story is in favor, the portfolio soars. But when sentiment shifts, as it always does, there is no floor of intrinsic value to halt the decline. Stocks can, and do, fall 80 or 90% and never recover. A single large position in a story stock that blows up can cripple a portfolio for years, making the goal of financial freedom an ever-receding dream. In contrast, a portfolio built on the principles of business valuation, a collection of profitable companies with durable competitive advantages bought at reasonable prices, is inherently anti-fragile. It may suffer during a broad market downturn, but its components are anchored to reality. They are generating real cash, selling real products, and serving real customers. Because their value is tied to this economic reality, they are far more likely to recover and continue their long-term upward trajectory of growth. Protecting your capital from the permanent impairment that story stocks can inflict is one of the most important and least appreciated aspects of successful long-term wealth management. By rigorously filtering out investments based on narrative and insisting on a foundation of predictable cash flow, you are building a financial fortress, not a house of cards. You are choosing the slow, steady, and certain path to capital gains over the exciting but treacherous path of speculation. This brings us to the final pillar, the capstone that locks the entire structure into place. You have adopted the mindset of a business owner. You have learned how to calculate the true owner earnings of a business. You have used the discounting mechanism to translate those future earnings into a concrete present value. You have trained yourself to resist the siren song of story stocks. You now have a number in your hand, a rational, defensible estimate of a company's intrinsic value. But the final, and perhaps most crucial step in the Warren Buffett strategy is what you do with that number. You do not go out and pay that price. This is where the fifth pillar comes in, the margin of safety. This is the simple yet profound idea that you must always buy a stock for significantly less than your estimate of its intrinsic value. It is the bridge between price and value, the ultimate defense against the uncertainties of the future, the errors in your own judgment, and the emotional madness of the market. It is the single greatest secret to consistently tipping the investment odds in your favor. The perfect historical anecdote to illustrate this principle is Buffett's investment in American Express during the infamous salad oil scandal in 1963. American Express was, at the time, a blue-chip company, widely respected for its travelers' checks and credit card businesses. However, one of its smaller divisions was in the warehousing business. This division had issued warehouse receipts for massive quantities of salad oil to a company called Allied Crude Vegetable Oil. The problem was, the salad oil didn't exist. The company's founder had filled the giant vats mostly with water, with a thin layer of oil on top to fool the inspectors. When the fraud was discovered, Allied Crude went bankrupt, leaving its creditors holding worthless warehouse receipts guaranteed by American Express. The market panicked. Wall Street analysts predicted that the liabilities from the fraud would be enormous, potentially bankrupting American Express. The story was terrifying, and investors fled in droves. The stock price was cut in half, plummeting from over $60 to $35. The narrative was overwhelmingly negative. This is where Buffett's disciplined process kicked in. While everyone else was reacting to the story, he was doing the work. He first determined that the maximum possible loss from the scandal was far less than the market feared, and was something the company's powerful earnings could easily absorb. But he didn't stop there. He wanted to understand if the scandal had damaged the core of the American Express franchise, the trust people had in its travelers' checks and credit cards. So he did his own on-the-ground research, what Peter Lynch would later call scuttlebutt. He went to banks and asked tellers if they were still readily cashing American Express travelers' checks. He went to restaurants and hotels and asked if customers were still using their American Express cards. The answer, overwhelmingly, was yes. The scandal, while a headache for the warehousing division, had not dented the public's confidence in the company's core, incredibly profitable businesses. He then performed his valuation analysis. He calculated the intrinsic value of American Express based on the immense and durable cash flows from its payment businesses, and concluded it was worth at least $65 per share, even after accounting for the salad oil losses. The market, in its panic, was offering him this $65 business for just $35. He was being offered $1 for 54 cents. This was his margin of safety. He invested 40% of his partnership's capital into American Express, a massive bet. As the panic subsided and the company's true unimpaired earnings power became clear to the market, the stock soared, doubling in just 2 years and making a fortune for Buffett and his partners. He was able to act with such conviction in the face of widespread fear because he wasn't guessing. He had a calculated value, and he was buying at a deep discount to that value. That discount was his shield and his sword. The psychological principle that the margin of safety so brilliantly counteracts is loss aversion. Decades of research by behavioral economists like Daniel Kahneman and Amos Tversky have shown that for humans, the psychological pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $100 feels twice as bad as finding $100 feels good. This asymmetry makes us incredibly risk-averse and prone to panic. When a stock we own starts to fall, the pain of loss aversion kicks in, tempting us to sell at the worst possible time to make the pain stop. A margin of safety is the ultimate psychological antidote to this destructive impulse. When you know you have purchased a stock for 50 cents on the dollar, you have a built-in mental buffer. If the stock price drops another 10 or 20% after you buy, it doesn't trigger the same panic. Your rational brain can override the emotional one, reminding you, I already bought this at a ridiculously cheap price. It's even cheaper now. The business is still fine. This is an opportunity, not a disaster. This mental fortitude, the ability to remain calm and even get greedy while others are fearful, is a superpower in investing. That superpower is not born from innate courage. It is born from the confidence that comes from having done the valuation work and having insisted on a large margin of safety. It protects you not only from bad outcomes in the market, but from the worst-case scenarios created by your own psychology. The applied mental model for this pillar is the elegantly simple 50-cent dollar rule. This is how you translate the theory of margin of safety into a concrete, non-negotiable investment discipline. Step 1. Using the discounted cash flow analysis we've already outlined, you calculate your best, most conservative estimate of a company's intrinsic value per share. Let's say, for a high-quality company like Microsoft, you arrive at a value of $400 per share. This number is your anchor. Step 2. You will not buy the stock at $400. You will not buy it at $390. You must pre-commit to a required discount. The size of this discount should vary depending on the quality and predictability of the business. For a fortress-like business with a wide moat and extremely stable earnings, you might require a 20 to 30% margin of safety. Your buy price for Microsoft would therefore be between $280 and $320. For a more cyclical or less predictable business, you must demand a larger discount, perhaps 50%. If you value a decent but more volatile business at $100 per share, your buy price is $50 and not a penny more. Step 3. You create a watch list of 20 to 30 wonderful companies whose businesses you understand. You do the valuation work for each of them. You set your buy price based on your required margin of safety. Step 4. You wait. This is the hardest part. You must cultivate the patience of a sniper. You do nothing until the market, in its infinite and recurring fits of madness, panic, or pessimism, serves up one of your target companies at your predetermined price. You let Mr. Market's manic depressive swings work for you. This discipline completely transforms your relationship with the market. You are no longer a reactive participant, chasing stocks up and panicking them down. You are a patient, calculating business person, waiting for the exact pitch you want to hit. This is the pinnacle of the value investing strategy. The antithesis of this patient, value-anchored approach is the strategy of the momentum investor, buying high and selling higher. This is the path followed by the vast majority of retail investors, especially during bull markets. They see a stock that has already had a huge run, a Tesla, an Nvidia, and they pile in, driven by a powerful fear of missing out. Their investment thesis is not based on any calculation of intrinsic value. Their entire thesis is that the stock will continue to go up simply because it has been going up. There is no margin of safety here. In fact, there is a margin of danger. They are explicitly paying a price far above any reasonable estimate of the company's current intrinsic value, betting that a greater fool will come along tomorrow and pay an even higher price. This strategy can work for a time, and it can create the illusion of genius. But it is fundamentally a bet on continuing market psychology, not on underlying business performance. When the momentum inevitably shifts, when the story changes or the growth expectations are not met, these stocks fall faster and further than any other, because there is no valuation floor to stop them. The momentum investor who buys at the top is left holding the bag, often with devastating losses from which their portfolio may never recover. It is the surest way to violate Buffett's first rule of investing: never lose money. The direct financial connection of rigorously applying a margin of safety is that it fundamentally alters the risk-reward profile of your entire portfolio. It creates what professional investors call asymmetric returns. When you buy a wonderful business for 50 cents on the dollar, the investment becomes a heads I win, tails I don't lose much proposition. The upside is significant. The stock can double just by returning to its calculated intrinsic value, and can go far beyond that as the business continues to grow. The downside, however, is limited. How much lower can the stock really go if it is already trading at a deep discount to its tangible value, is profitable, and has a strong balance sheet? This built-in asymmetry, consistently applied across a portfolio of investments, is the mathematical engine that drives superior long-term risk-adjusted returns. It allows you to build a portfolio that captures a significant portion of the market's upside while providing far greater protection during downturns. This is the holy grail of portfolio management. It is how you build resilient generational wealth. It is not about being smarter than everyone else. It is about being more disciplined, more patient, and more rational. It is about doing the work to determine value, and then having the fortitude to wait for the market to offer you a price that provides a massive margin of safety. This is the final and most powerful piece of the puzzle, the culmination of the entire Warren Buffett strategy for turning the complex art of stock picking into a rational, repeatable process for achieving financial freedom. You have just been given a powerful weapon, a complete mental framework for valuing any business, a shield against the most common and costly errors that plague investors. You've learned to see stocks not as tickers but as businesses. You've learned how to cut through the fog of accounting to find the true owner earnings, the real cash profit. You've learned how the force of interest rates governs value, and how to use a discounted cash flow analysis to translate the future into a concrete number today. You have been inoculated against the seductive poison of story stocks and, most importantly, you now understand the critical importance of a margin of safety, the ultimate buffer against a future that is always uncertain. This isn't just theory. This is a practical, actionable toolkit that has been proven to work for decades, a system for thinking that can permanently alter your financial trajectory. The time you have invested here has equipped you with a way of seeing the market that 99% of participants will never grasp. But it is crucial to understand that what you have just mastered, as powerful as it is a single critical node in a much larger network of mental models. Warren Buffett's and Charlie Munger's success is not the result of one single trick or formula. It is the result of a latticework of interconnected concepts from economics, psychology, history, and science. The valuation framework is the engine, but it needs to be connected to the chassis of competitive analysis, the steering wheel of behavioral discipline, and the braking system of risk management. You have built the engine, but there are other pieces to the machine. You have been given one page of the map, a crucial page that shows you the destination, but the complete map reveals all the routes, the shortcuts, and the dangers along the way. The video that is now on your screen is another piece of that map. It might not seem directly related. It might be about a different investor, a different psychological bias, or a different aspect of business strategy. But the YouTube algorithm, in its own way, is trying to guide you. It is showing you what it believes is the next logical step in your journey. Think of it as the missing link, the piece that connects the valuation engine you just built to the next part of the machine. The journey to becoming a truly sophisticated investor, a master of your own financial destiny, is a process of assembling this complete mental arsenal, piece by piece. It is a commitment to continuous learning, to bolting on new models and strengthening your latticework of knowledge until it is an impenetrable fortress. The choice you face now is not simply whether to watch another video. It is a choice about who you want to become. Do you want to remain a tourist in the world of finance, armed with a single idea? Or do you want to continue the ascent to become a true architect of your own wealth? The next piece of the blueprint is right there. The only question is whether you are committed enough to your own success to take it. Continue the journey. Complete the map. The click you are about to make is not for more content. It is a vote for your own future self.